Okay, you've definitely heard the phrase, let your money work for you. We all have. But have you ever really stopped to think about how it's working? What's actually going on under the hood? Is it just ticking along steadily, or is it doing something else? Something that maybe starts small but really uh, picks up steam?
That's exactly what we're digging into today. It's about these two core ideas, simple and compound returns. And we're not just going to define them and move on. We want to get into the strategy, where they
Hmm.
help, where they might actually hurt you. It's frankly more important than just knowing the formulas.
Totally agree. So our mission for this deep dive is really to give you, the listener, that practical edge. We'll look at where simple return makes sense and then where compounding really takes over. Knowing the difference is key for, well, smarter investing, smarter borrowing too. Think of this as your shortcut to getting that financial intuition right.
Right. So let's start with simple return. It's the more straightforward one. Most people get this instinctively. Your money earns a fixed percentage, but only on the original amount you invested the principal. That's it. Any earnings don't get rolled back in to earn more. It's, well, simple, predictable.
Okay, predictable. So like if I put in, say, $1,000
Yeah.
and it's getting 5% a year, simple return for 3 years, how does that actually play out? Just walk us through it.
Yeah, easy. That 5% is always calculated on the original $1,000. So you earn $50 in year one, $50 in year two, and $50 in year three. After 3 years, you've made a total of $150 in interest. Your total is $1,150. See, the interest payment is the same each year. It doesn't build on itself.
Got it. $50 to $50,
Mm.
very clear, very easy to track. And you see this with certain kinds of short-term things,
Yeah.
like bonds or maybe some loans.
Exactly. Some short-term investments, certain types of personal loans. Its main advantage is that transparency and ease of calculation. But that predictability is also its biggest limitation for growing wealth long-term. Because those $50 earnings aren't put back to work. You're missing out.
Right. You're missing that kind of growth-on-growth effect.
Yeah.
Which brings us to the other side of the coin, compound return. This is where things get more dynamic, isn't it?
Oh, absolutely. If simple return is like a steady jog, compounding is, well, it's like a snowball rolling downhill. It starts slow, but it picks up speed. It calculates your return not just on that initial principal, but also on all the interest or gains you've already earned. So your interest starts earning its own interest. That's the core idea.
Earning interest on interest. Okay, that sounds powerful. How do we, like, picture that? Is there a good analogy?
Yeah, a really common one is planting a tree. So the tree grows, produces fruit, fine. But with compounding, you take the seeds from that fruit, plant more trees. Now, those trees also bear fruit, and you plant their seeds, you see. You're not just getting fruit from the first tree anymore. Your orchard is expanding. It's exponential.
Okay, I like that, the expanding orchard.
Yeah.
So back to the numbers. Same scenario. $1,000, 5% interest, 3 years. But this time, it's compounded annually. What's the outcome?
Well, year one is the same. You earn $50, so you have $1,050. But in year two, you earn 5% on the whole $1,050. That's $52.50. So now you have $11,002.50. Then year three, you earn 5% on that amount. By the end of year three, you have $11,157.63.
So it's $11,157 with simple interest and extra $7.63. Doesn't sound like a huge difference initially.
Exactly. Over just 3 years, it's small. But stretch that out. Over 10 years, simple interest gives you $1,500 total. Compound interest, that gets you to $1,628.89. Now the gap is widening.
Okay, see.
And imagine 30 years. That's where the lines on the graph really diverge. Simple interest is just a straight, steady line going up. Compound interest. It curves upward, steeper and steeper. It really shows how compounding accelerates over the long haul. It kind of defies our normal linear way of thinking.
Right, that exponential curve. So this isn't just theory then. For anyone investing, this compounding effect is, well, it's huge, isn't it? It's the Warren Buffett get-rich-slowly engine, essentially.
Precisely. It's often called the investor's best friend. Let's make it really concrete. Imagine you invest $5,000 every single year. And let's say you get a pretty reasonable average return, maybe 7% per year, compounded annually. And you do this for 30 years.
Okay, $5 a year, 7%, 30 years. What does that turn into with compounding doing its thing?
With compounding using the future value calculation, that grows to $472,304.
Oh, 470,000. Okay. Now, just for comparison, what if compounding wasn't happening on those returns? If it was just the contributions earning interest simply, or maybe no return on the gains at all?
Right, if you just collected the returns perhaps, but didn't reinvest them, or if you somehow only got simple interest on each contribution, well, the total contributions are $150,000, $5K by 30 years. Even with simple interest added, You'd end up far short. Let's say, for argument's sake, a non-compounded scenario yielded $312,750.
So comparing $472,000 with the compounding versus, say, $312,000 without, that's a difference of nearly $160,000.
Exactly. Almost $160,000 more, just because the earnings were plowed back in to generate more earnings. It nails that formula. Time plus compounding equals wealth. It's almost effortless once it gets going.
That is seriously impressive for just letting the system work. Now, for people trying to get a quick feel for this doubling power, there's that mental shortcut, right? The
Yeah.
rule of,
The rule of 72. Yeah, it's a great little approximation, super useful for quick estimates. You just take the number 72 and divide it by your annual interest rate as a percentage. The answer is roughly how many years it'll take for your money to double.
okay, so if my return is, say, 6% a year.
Right, 72 divided by 6 is 12. So it will take about 12 years for your investment to double at a 6% compounded return. If you're getting 9%, 72 divided by 9 is 8. It'd take around 8 years. It's not exact science, it assumes annual compounding, but it gives you a really good gut check on growth potential or even the cost of waiting to invest.
Yeah, that really frames the time aspect well. Okay, so far we've mostly talked about annual compounding, but interest can be compounded more often, right? Like monthly or even daily. Does that make a
Oh,
difference?
it definitely does. The more often the interest is calculated and added to your principal, the more frequently your money starts earning interest on that slightly larger amount. So more frequent compounding means slightly faster growth.
How much faster? Is it noticeable?
Let's take an example. Say $10,000 invested at 5% for 3 years. Compounded annually, we saw that gives you $11,576.25. If it's compounded quarterly, so 4 times a year, it's $11,607.55. Monthly compounding, $11,614.72. And daily, $11,618.22.
Okay, so over 3 years, the difference between annual and daily is, what, about $42? Still
Wow.
small.
It does seem small over just 3 years, but remember that exponential curve? Extend that out to 20 or 30 years, and those small differences in frequency really start to add up to significant amounts. It's another layer to the compounding effect.
Gotcha. So more frequent is generally better for the investor,
Mhm.
but, and this feels like a big but, that same power can work against you, can it?
Mm-hmm.
When is compound interest actually bad news?
Absolutely. When you are the borrower, that's when compound interest can be really dangerous. The classic example is credit card debt. If you carry a balance, the interest is often compounded daily. So you're paying interest on yesterday's interest, which was calculated on the day before's interest. It snowballs incredibly fast. That's how people get into trouble.
Right. So that daily compounding on debt is the opposite of what you want, which means sometimes simple interest is actually better.
Yes, definitely. If you're taking out a loan, like a car loan or a personal loan, many of those use simple interest. That means the interest calculation is based on the original loan amount or the declining balance, but the interest itself doesn't typically compound in that aggressive credit card way. It's much more predictable and manageable for the borrower.
Okay, so that leads to a pretty clear rule of thumb then.
It really does. Simple version. If you're borrowing money, look for simple interest if you can. It's generally more favorable. If you're investing money, you absolutely want compound interest to be working for you. That's your growth engine.
Makes sense. Simple for borrowing, compound for investing. Now, there's one other term related to this key AGR. What's that about?
CAGR, compound annual growth rate. Think of it as a specific type of compound return calculation. Its main job is to smooth out the bumps. You know how investments rarely grow at the exact same rate every year? They go up, they go down.
Yeah, like a roller coaster sometimes. A 20% gain one year, maybe a 10% loss the next, that up 15%.
Exactly. So KG takes that volatile performance over a period of time and calculates a single hypothetical steady growth rate that would have gotten you from the starting value to the ending value over that same period, assuming the growth was perfectly smooth and compounded each year.
Okay, so why calculate that smoothed out number? What's the advantage for an investor?
It's incredibly useful for comparison. Let's say you're looking at 2 different mutual funds over the last 10 years. Their year-to-year returns might look wildly different. Calculating the KGR for both gives you a single standardized number to compare their overall long-term performance. Cutting through that volatility, it helps you see which one actually delivered better growth on average over time. It gives a clearer picture.
Got it. So KGR is like the average compound speed, even if the actual journey was bumpy.
Okay.
Okay, let's quickly recap the main distinctions then. Simple versus compound.
Right. Simple return. Think straight line, linear growth. It's calculated only on the initial principal. No reinvestment of gains is factored in.
And it's best for shorter terms, or when you're the borrower on certain loans, because it's predictable.
Exactly. Compound return. Think curved line, exponential growth, calculated on the principal plus all the accumulated returns. Reinvestment is the key.
And that's the powerhouse for long-term investing, gives you much bigger gains over time. But it can be really costly if you're borrowing, like with credit cards.
You nailed it. That's the core difference in a nutshell.
So the big takeaway here, the sort of golden rule we want you to remember from this deep dive, is pretty straightforward, isn't it?
It really is. If you're borrowing, lean towards simple interest where possible. If you're investing, you want compound interest working its magic for you.
And just understanding that difference, really understanding it, is incredibly empowering. It can literally save you thousands on loan payments, or, conversely, help you build that nest egg way faster.
Absolutely. Simple return might feel easier to wrap your head around initially, but it's compound return, that relentless growth on growth that truly builds wealth over the long run. It challenges our intuition sometimes, but the math doesn't lie.
So maybe the final thought to leave you with is this. Given the power of compounding, what's one small, consistent thing you could start doing, maybe even today? One small action to get that snowball rolling, or maybe rolling a bit faster for your own financial future. Often, it's not about finding some miracle investment. It's about consistency and letting time and compounding be your allies. What could that look like?